Financial Reporting and Accounting Standards update. As I reminded my colleagues earlier today, The Accountant Part 2 with Ben Affleck is coming out soon. So who says accountants are boring? So I'd like to start out with an acknowledgement of country. So I'm coming to you from the City of Casey, and we proudly acknowledge the traditional owners, Casey's Aboriginal communities and their rich culture, and pay respect to their elders past, present and future. I'd also like to extend this acknowledgement to all the grounds that everyone is meeting virtually on today. We acknowledge the Aboriginal people as Australia's first peoples and as the traditional owners and custodians on the land on which we work and live. So I'd like to, again, thank you very much for coming along, and I'll start off by introducing our two very accomplished presenters today. Today we have Nick Walker, who's from HLB Mann Judd, and Nick has 25 years plus experience in delivering audit and assurance services across a broad range of industries. Nick's public sector experience includes both the Auditor General and ANAO engagements, and he has worked on local government engagements throughout his career. We also today have Carmen Ridley with us, and Carmen has been in auditing and accounting roles for over 25 years and worked in the technical department of a Big Four firm prior to running the technical auditing and accounting divisions of a couple of mid-tier firms. Carmen provides the role of a technical auditing and accounting division for a range of clients and ensures that she keeps up to date and aware of current accounting and auditing issues, and has established her as a recognised expert in the financial reporting arenas. Carmen was a board member of the AASB board from 2012 to 2020 and a former member of the International Accounting Standards Board, IFRS for SME Implementation Group. Carmen has presented numerous training sessions for corporates, not-for-profit entities, government agencies, local councils and accounting firms. Carmen is the Principal and Director of Australian Financial Reporting Solutions. So now that we've introduced the session, I'll just hand over to Nick, I believe.
Me, you're handing over to
Carmen.
Thank you. Well, it's me.
Sorry.
That's all right. Welcome everybody. If we are hoping to answer some questions during this session, but we are just going to ask if people can type them into the chat box, and we will look at them at the end. Although if I see any flick up as I'm presenting that I can answer straight away, I will do that. So let's get started, because we've got a fairly jam-packed hour ahead of us. There's a technical issue that is not coming back. So what I want to start with is what is new. So the good news is there is no major new accounting standards that are going to be kicking in for 30 June. I'm not here to announce a new revenue standard or a new leasing standard or anything like that. But we are going to talk about one standard that particularly I think could make our financial statements much more meaningful, much more useful. And that is a change to AASB 101 and a change to 108. Now, that introduces two different things. The firstly is a definition of accounting estimates. To be honest, that's not going to change the world. It really isn't something that you probably were aware that we did not have a definition of accounting estimates. The one that is more interesting is the move from significant accounting policies to material accounting policy information. Now, what does that actually mean? Is it just a wording change? It's not intended to be. So it's intended that what we will do is to change the accounting policies rather than that boilerplate, those template ones that we're used to copying in, is to actually say, will this accounting policy information be material in that will it affect the decisions of the user, rather than just the exact same accounting policies that we have in every single set of accounts. So if we have a look at what makes an accounting policy material, we flick on the next slide, please. So there's two limbs to this definition. The first is that the thing that's generated the number has to be material. So it has to relate to a material transaction, event, or condition. If it's not material, the accounting policy information can't be material. So we shouldn't have anything in there that doesn't relate to a material transaction, event, or condition. Then we look and we say, okay, if we do have this material event, transaction or condition, we look at those 5 bullet points on the slide. And in order for our accounting policy information to be material, it should meet one of these criteria. So the first is it relates to a change in accounting policy. I don't generally see councils changing accounting policies very often. Normally, your accounting policies in many cases are mandated for you, and you haven't actually got any choices. We'll talk about that later. But once you've stuck with that accounting policy where there is a choice, you don't generally move it. Don't expect, therefore, that criteria to be overly common for you. The next is where we have a choice within the accounting standards. Now, councils are in the interesting space that whilst there is lots of choices in the standard, many of those choices have been made for you. Now, even though those choices are made for you, you are still required to explain to the user what choice in the standard has been used. So, for example, infrastructure, property, plant and equipment, the standard allows you to hold them at cost or fair value. You can't. You have to hold them at fair value, but we still need to include that information because it is a choice within the standard. So for all of you, your infrastructure, property, plant and equipment would be material, and therefore we are required to make sure that we include that element to say it's at cost. Sorry, it's at fair value because that is a choice. The third one, again, I don't expect huge relevance for councils. So what this says is because our standards are principles based, we are required to look and say, does our transaction covered by the accounting standard? And most cases for you, the answer is yes. However, if we have a situation where it's not explicitly covered, we have to effectively make up an accounting policy. So criteria number 3 says where we have made up an accounting policy, we are required to explain that to the user, because if we've made it up, there's only one way the user is going to know what we've done, and that's if we tell them. As I said, don't expect that to be hugely common for councils. The next one, however, is so we are required under our standards to disclose significant estimates and judgments. And if we think about your financial statements, some of those estimates and judgments are probably boilerplate, probably taken from the pro forma, the template financial statements. Those disclosures generally aren't great in financial statements across any sector. So what this says is if you have a significant judgment and estimate, you may need the accounting policy information to provide more context to that, provide more explanation to that. You may not. If you've got a really great judgment and estimate note, you won't need the accounting policy because you've already explained all of the judgment, the estimation involved. So you need to think about effectively what's kept you up at night. Where were you just not sure about which inputs, which assumptions, which estimates you were going to put in, because it could have quite a significant impact on the numbers. Or where was there a judgment issue? And depending on which side of the fence you fell on, again, that could have a material impact. The last one, in my personal view, is the International Board covering themselves. So they potentially were concerned that if they'd only included the first 4, maybe there was something that was material that didn't capture into any of those 4. So what it says is, if you have a transaction that is so complex that the only way that you will understand it is if you include accounting policy information, then you need to include that. Now, the example it gives within the standard is where you've applied 2 standards to the same transaction. You guys do that every single day in your revenue space with 1058 and AASB 15. In my view, that is not so complex that the only way we can understand it is if we include that. I, at this point, have not yet thought of anything I would slot within that 5th criteria. So to me, the first 4 are the ones we really should be looking at. And for councils, it's the second one. It's the documentation of the choice, and it's a significant judgment or estimate. Now, having gone through that, what we need to think about, therefore, with your accounting policies, probably lots of pages, lots of words within there. And if we think about particularly what we should consider, there's a few things I want you to think about. So if we flick on, please. So I want to make sure our accounting policies includes how has council applied the requirements of the standard, not what do the accounting standards say, because we're already making a statement that we comply with the accounting standards. Therefore, we don't need to say the accounting standards require this and include extracts. We're looking very clearly at what has council done. So if we take your infrastructure, property, plant and equipment accounting policy, generally about 3/4 of a page of a policy. We now need to think about how does this apply? It's important to know how it's recognised. So infrastructure, property, plant and equipment is recognised at fair value. It's important to know your depreciation basis. So is it straight line or is it reducing balance? And it's important to know the useful economic lives. Anything else is just an extract from the accounting standard if when you take a step back and you read that. So instead of having all of that regurgitation, we've got really specific information about you, your council, and how have your numbers been put together. And that's the intention behind this particular standard. It does acknowledge that you may, the standard says, you may include immaterial accounting policy information. However, that is not to obscure material accounting policy information. And again, I think this is the board covering themselves to say we're not necessarily assuming everyone is going to go through and wipe out all their policies. I would love it if that was the case, but we know it's not necessarily going to happen. So you have to think about if you aren't going through and deleting the immaterial stuff, have we just got everything in a big mismatch of 8 to 10 pages of accounting policies? And if we have, that's obscuring. So what you might say is, okay, well, what we'll do is we'll split them up. And at the beginning, we'll have our material accounting policy information. And at the end of that section, or in a note at the back, we'll have the immaterial accounting policy information. Fantastic. Just delete the section called immaterial accounting policy information. Because if it's not material, why are we talking about it? We might slot our accounting policies under the notes. Again, maybe you could argue you're not obscuring, but why are we spending 3/4 of a page just regurgitating what the accounting standard says when we really don't need to? In relation to guidance on this, there is a document called Practice Statement 2. So if we have a look at a decision tree from that particular document, Practice Statement 2 is called Making Materiality Judgments. Next slide, please, Nick. It's called Making Materiality Judgments. It has been written for preparers, and those preparers gives guidance around how do you know something is material. There isn't a huge amount of guidance for you. It is a document specifically written for preparers that has been updated recently for this accounting policy information. So I've just copied this straight from the document. It's exactly what I've just been talking about. It just presents it differently, a bit of a picture format. So I would encourage you, if you haven't looked at that, it is on the AASB website, and it's some really quite useful guidance about materiality generally in relation to that. So that's the big standard, if you like, that requires any effort at 30 June 2024. There are a couple of other standards that are in play, but I don't expect them to have huge impact for councils. So for completeness, let's have a look at them. The first one is in relation to deferred tax. Now, I think the only way this is going to have impact is if you do have a for-profit subsidiary or an entity that you do have that investment in from a for-profit perspective that is doing any tax calculations, that is doing tax accounting. And effectively what this says is if you weren't recognising deferred tax on lease transactions or make good transactions in the past, you need to now. So it effectively narrowed an exception that existed. Not a huge impact, as I say, if you do have any of those for-profit subsidiaries, just something to think about. The next one will have absolutely no relevance for councils. It is part of the global push to try and make multinationals pay the right amount of tax. So it's to do with domestic minimum top-up tax. Not going to go through it in any further detail. The last one is everybody's favorite type of standard, and this is an administrative standard. So this is where the staff have gone through and made editorial corrections. So there was a comma here and there shouldn't have been, or there wasn't a comma and there should have been, and some minor typos. They've also, because our standards have the force of law for corporates, they all sit on the legislative instrument register, and they've just gone through and repealed all of those old standards. So we'll have zero impact on any entity, which means that when we are putting together these of the standards we've adopted, we just need to make sure that we don't include things that aren't relevant for us. That, again, part of decluttering should be a relevant list. I purely included this for completeness for you. So that's it of the new standards. Just wanted to focus on another couple of things. Generally, when I talk to councils, they often say to me, what's happening with 1058 and AASB 15? Are we going to get rid of some of the complexities around this? So the AASB commenced a post-implementation review a couple of years ago now. It was put on the back burner because of the sustainability work. These 8 topics were included within that post-implementation review, and a number of you may have been involved in various roundtables, various discussions that they held. At the meeting in December last year, they did talk about sufficiently specific, which in my experience seems to cause the most issues. The feedback that they received was effectively, it's not broken, don't fix it. Now, there was quite a passionate discussion that happened at the December meeting with a couple of board members saying that's not what we have heard. So they directed staff to go away and do some more targeted outreach on this. Topic 2 is also potentially relevant to councils. So this is the exception in 1058 that allows you for your construction of assets when you receive a grant to not recognise that grant on day one. You recognise it as you are constructing that asset, as long as it meets certain criteria. One of the criteria is that the asset has identified specifications. There's no guidance in the standard on what that means. So if you get money for roads, is that an identified specification because it says the type of asset? Generally, people say no. It needs to be, it's a road that goes from A to B. It's to be a multi-lane road. It's to be a single lane road. It's to be sealed, whatever it is. People want a bit more substance around what it is. The board has agreed that they will put out some more guidance around that identified specification, which may change what we see in practice. We don't know until it's out there. As we speak, the AASB is in a 2-day board meeting. It started at, I think, 10 o'clock this morning. Post-implementation review is on the agenda for tomorrow, so we should see something that comes out after tomorrow. They have said they're going to discuss each of these 8 topics. I have to admit, I have not read the board papers, and I'm obviously not attending the board meeting, so I can't tell you what the board is going to decide, but their action alert will come out on Monday, so we'll be able to see if anything is coming from that. Just while I talk about that, AASB do hold public meetings. So if anybody is interested, you can register and attend any session. You don't have to attend the whole lot. You can pick any session and attend virtually if there is anything that interests you. So we're moving away from our accounting standards and moving into that sustainability space. So I thought it would be useful to just talk through effectively the key players and what is happening in this space. It is the biggest issue at the moment, and it is a complete moving target. So we're talking about what is happening today as at the 6th of June. Tomorrow may be different. Next week could be completely different again. So that's why I thought I'll focus on the key players and then I guess some of my personal views on what I think this will mean for councils. So the first player at the top is the ISSB. That is the International Sustainability Standards Board. That sits as a sister body to the IASB, the International Accounting Standards Board. And their aim is to issue a set of global sustainability reporting standards. They can't mandate it in any jurisdiction, but we have been told in Australia by the federal government that the intention is that Australia will use those standards as a base. Hence the reason that's why we're talking about them. Their first two standards have been issued. They were issued in June 2023. They are IFRS S1 and IFRS S2. So if anybody is interested, those standards are out and are available. The first one is an umbrella standard that deals with general sustainability reporting. The second one is a climate-related standard that deals with climate-related disclosures. Now, the federal government is the next entity. They're relevant for councils in respect of they have declared at this point that in Australia, the focus is on climate. Consequently, our standards, when they are issued, will have a very climate-based focus. At this point, we don't seem to care about things like modern slavery, diversity, nature, etc., because our standards are going to be very focused on climate. The other relevance of the federal government is they're the ones who effectively put their heads out of the trenches and said, we're going to go first. With the entities who we are responsible for, they are the first group who are going to be required to do mandatory climate-related disclosures. Now, who are those entities? It's companies within Australia. So it is currently, again, as we speak, being debated in federal parliament. A law was put to federal parliament on the 27th of March. It has gone through its first reading, its second reading, it's gone back to the House for further discussion. That mandates climate-related disclosures for various companies and their size threshold. So it's going to be phased in through size. If councils were applying this, they're not, because they're not Chapter 2M. Most councils would fall under the Group 1 type entity. So you are pretty massive with respect to your revenue and your assets. So those type of entities in the private sector are going to be captured from 1st of January 2025. One of the things to be aware of is, again, this is my personal view. My personal view is I don't believe that the federal government can put this significant impost on private sector entities without effectively putting their money where their mouth is and saying, we're doing it. Our departments and our agencies are going to do it. If the federal government goes, every state and territory will have to follow from their departments and agencies. I work with some jurisdictions in Australia in relation to councils, and I'm talking to both those jurisdictions about what are we doing in the council space for this. There will be consultations, but to me, again, my personal view is I think this is a when, not an if, for council space. So whilst I'm not trying to terrify anybody, and we're giving a very high level view here, just be aware that you will need to start thinking about climate, your risks, your strategy, your governance, etc. So if we look at the AASB, sorry, can we go back a slide, please? If we look at the AASB, they are going to be responsible in Australia for issuing the sustainability reporting standards. Now, that's great in a way because they have a structure for standard setting. The bad news for everybody who's on this call, because most of you are from the finance team, is because something is coming out from the AASB, everybody goes, it's not us, it's finance. Finance deal with the AASB, Australian Accounting Standards Board. This is not a finance issue. Finance absolutely will get involved because finance are part of the senior leadership team of a council, but this is a whole of council issue. So therefore we need to start thinking about what committee, what team is going to look after this. Please make sure it doesn't fall on you guys because you will be busy enough with everything else when this comes through. The fact that I've got the auditing board on here tells you that at least for the company level, this is intended to be audited. So it's not something we can put out there and actually say, oh, this is what we think. Auditors are going to have to do something with it. Now that's about where we're seeing in that where we're seeing in that reporting mandatory. The one thing I do want to raise for councils is the standards as they stand at the moment, the exposure draft as it went out, will require these companies to report their Scope 1, their Scope 2 and their Scope 3 emissions. Scope 1 is where you are a direct emitter. Scope 2 is effectively purchased electricity. Scope 3 is along your value chain. So if we think about, do you, as a council, fall into the value chain of any significant companies that may be mandated to report? If you have companies, for example, that get rid of huge amounts of waste and that goes to your landfill or it goes to your recycling facility, can you report on the carbon emissions of that facility? if you are asked to do it. Because if you are in somebody's scope 3, you will be asked to provide that information. So just think about who you deal with, and have you got entities who may be required to mandatorily report, and can you capture that carbon information if requested? So that's where we're going in the future. If we now have a look at where we sit today. So if we move on, please. Our standards don't talk about climate change, don't talk about climate risk, but they didn't talk about COVID either. And we all coped with the fact that our inputs, our estimates, our judgments, our assumptions needed to change because of the environment that we are in. Now, whether you believe climate risk or climate change exists doesn't matter, because investors do, users do, regulators do, consumers do. So therefore, when we are thinking about putting together our 30 June 24 numbers, we have to think about, does climate affect any of those numbers? So if we take, for example, infrastructure, property, plant and equipment, do we have assets that are in an area that are prone to flooding? Do we have areas that are prone to bushfires? And have we done anything different with those assets? Have we had to shorten useful lives? Have we had to spend more money on assets because we need more resilient materials that make those up? How is that affecting what we're doing? In relation to our provisions, our landfill provisions, our remediation provisions, are we having to do them for a higher quality now because people are more aware of making sure that things are put right to a better standard than where we were previously? Fair value. How's the ESG issues affecting your fair value? Or isn't it? And if it isn't, should it be? I'm a huge fan of the UK FRC. They do some great work where they look at lots of disclosures of different entities. And I've put this extract in from one of their reports. It's back from December 2021. And the reason I put this in was because it's the first and probably the only time I have seen in a set of financials somebody acknowledging that the valuation of their assets may well be changing because of ESG issues. So if you are engaging valuers this year, speak to them. Is climate affecting anything? We know that there is IPWEA, so the Institute of Public Works Engineering Australia, who gives guidance around useful lives of public sector assets. They've put out, I'll call it an addendum for want of a better word, that talks about how climate is affecting the useful lives of public sector assets. So we've definitely got these resources out there. Just make sure that we are thinking about some of these as we put together our June financials. So that's it on the new stuff. I'm going to spend the last 5 minutes just giving you some reminders. Now I'm sure that you won't be surprised on what topics I am going to cover in here. So let's have a look. Fair value. Sure, many of you are rolling your eyes and going, yeah, we know all about fair value. We hear about it all the time. So just a little bit of a reminder for you. And then I want to cover the new standard that's coming in. So if we think about what do you need to do from an accounting standards perspective on an annual basis, there is a requirement in the standards that says on an annual basis, you have to consider whether any asset you hold at fair value is materially different, the current carrying amount from its current fair value. It does not say in the standard, you can just do a revaluation every 3 to 5 years and don't worry about it in between. It says every year you have to make that assessment. So consequently, if we think about how you do that, you need to think about potentially using indices, looking at that to try and determine whether there has been a material movement in that value. So how are you going to do that? What process have you got in place? So if your auditors say to you, have you done this check? Are you comfortable that there is no movement to fair value? You can actually answer them and show them the documentation. What we often see is when you do your independent comprehensive valuations every, say, 3 years, we see a massive jump in the valuation. That jump didn't happen in year 3. It was a result of what happened from years 1, years 2, and years 3. So we just need to get better at making sure we are considering what's happening on an annual basis. I then put together a few issues and errors that I see in relation to these revaluations of infrastructure, property, plant and equipment. I'm not going to read this. You can all read it as well as I can. I just want to talk generally about when you get back a valuation report, if you are using an external valuer, And often what the auditors tell me is when they have the conversations with their councils and they say, great, you've got a valuation report, fantastic. It's changed quite a lot. Why has it changed? And often the council staff answer with, we don't know, the valuer just did that and the number increased. So when you get your valuation reports, it's really important that you understand the inputs, the estimates, the assumptions. Why is it that something has changed? And is that what we expected to happen, or why has it moved differently from what we expected? In addition, if you have changed valuer at all during the year, we often see some massive fluctuations. Valuation is an art, not necessarily a detailed, precise science. So consequently, understanding those changes is really important. As I say, the rest of them are more kind of that processing type errors, just something to be aware of as you work through your values at the end of the year. So I wanted to just end my part of the session by talking about what is happening with, I'm still calling it the new standard. It came out in December 2022. It's not that new, but it's not in place yet. So it became effective for annual reporting periods beginning on or after 1 January 2024, which for councils is 30 June 2025. Now, to give you a bit of history of this particular project, it started when I was on the board. So the fair value standard was issued, and at the point of time that that fair value standard was issued, there was lots of consultation in Australia. One of the questions that was asked was, do we expect any big issues, I guess, for the public sector? And none came back. So the standard was issued as it was issued from the International Standards Board. No Australian specific requirements. Particularly in the public sector, due to the prevalence of fair value, as you guys and the departments and agencies started implementing this, they realized that actually this was quite a hard standard and there was lots of complexities. There was lots of judgment. So the board got back lots of, can you please look at this? And we're seeing these issues. So a project advisory panel was set up. I was a member of it when I was on the board, and I continued to be a member when I came off the board. And we were then looking to say, okay, what do we need to do in relation to this standard? It was really quite fascinating, this project, because even before we ever put anything out to comment, we got lots of comment letters back on it. And it seems to be, depending on where you are based in Australia, you have very different views. Now, what ended up being issued, the standard was issued in 2022. Effectively, what the board at the time decided to do is to knock off the issues that were controversial, in particular around restricted land and whether that should be discounted or not. So this standard that was eventually issued is effectively clarifying things, gives some additional guidance, but is not necessarily expected to change things substantially. So these comments here that I've put from the basis of conclusions is what the board who issued this standard at the time believed would be the case. So if we have a look at what this covers, so as I say, it's not effective yet, but needs to start thinking about it. So if we click on, please, it covers 4 specific topics. The first is highest and best use. And the idea behind this change was to reduce the amount of time, effort, and cost that the public sector have to spend trying to work out if their assets are held at the highest and best use. Probably not a surprise to most of you to know, they're not. They would be much better off. You get much more money back for them if they sold them for other uses. However, there generally isn't another use that is legally permissible. So rather than you spending all this time to go, well, it's not, but then there isn't another alternative use, the standard has been changed to say that you only need to look at highest and best use if either you've classified the asset as held for sale, or it's highly probable that you are going to use the asset for something other than its current use. So hopefully that just means that you're spending less time on highest and best use, much less effort for you. If you do have to look at highest and best use, there's been some clarity in that point B around what financial feasibility means. In point C, there has been additional clarity around when an entity can use their own assumptions. So if we think about within the standard, it requires us to consider the market participant assumptions. For many of your assets, there is no market participant other than you. However, we have to pretend there is. We have to assume a hypothetical market participant. This just gives extra guidance to say these are the circumstances where you can use the assumptions that effectively you would do rather than trying to pretend what the hypothetical person would do. And lastly, there is some more guidance around the cost approach. So it includes things, for example, that if you were going to do some works on a road, you may choose to do that works at night. It is going to be more costly to do that, but you're going to have much less people complaining about the disruption caused in doing the roadworks during the day. So therefore, you may well choose to do that, even though it will be more costly. And there's a fair number of examples around different scenarios about when you can include certain costs and whether you can't. So I don't expect massive change under this standard, but given how significant the fair value of your infrastructure, property, plant and equipment is, certainly something to just start thinking about, start looking at. It is not retrospective, it is a prospective standard. So when you adopt it from 1st of July 2024, it is those changes going forward. And if we have a look at some of the resources that are available, the basis of conclusions for this standard, ironically, is more lengthy than the actual changes to the standard itself. And that's because that goes through and it has all of the history of it, and it has why certain decisions were made and what the feedback was from the stakeholders. I'm not going to say it's a really interesting read, but it's certainly got a lot of information in there. So when you are implementing this standard, don't forget that basis of conclusions is actually a real hive of information there. I've then got a reference to a YouTube video. The AASB has a YouTube channel. Who knew? But they do. This video is about a 10-minute video, and it is Patricia Au, who is the senior manager who has effectively wrote this standard, explaining at a high level what the changes were, and more importantly, explaining what is not included within this particular standard. So again, not the most exciting video to watch, but it's a quick 10-minute. This is a high level on what is included. So certainly a great place to start when you are looking at this. And that is it from me. So happy to look at any questions if you type them as they come through, but otherwise, Nick, I'm going to hand over to you.
Thank you, Carmen. Yeah, so I've just been asked to just give some tips for the audit season and just from the auditor's perspective. Started off with logistics and communication, because I suppose with my my experience has always been is that if there's most councils pretty much know, and the finance teams in particular know what they need to do. They're aware of the requirements, and it's not like it's something they haven't done before. So a lot of the challenges come down to logistics and communication. And a bullet point that's not up on this slide, which I should have put up there, is that obviously communication goes both ways. This is not just me as an auditor saying what I think we would like to see. I think probably the most important thing is to sit down with the auditors at different stages during the audit, just to be clear on what's required, when it's required. Obviously, it's great for auditors to say what they need and what works for them, but it's also important for us to know what you need and the best way we can work with you. And so I'm hoping to some extent that's reflected in these slides. Probably the first point, which would be nothing new. I've worked on a number of councils, and most councils are pretty proactive in terms of preparing shell financial statements. It's just a great way to make sure that we're the current model is in place and lined up with the comparatives, but also that it's an opportunity to be a bit looking forward and making sure that there's any disclosure requirements or potential disclosure issues are discussed prior to the final audit, rather than trying to deal with everything at year end when everything's a lot tighter and deadlines are looming. The one that I guess we don't see a lot of is shell performance statements, and again, performance statements can be something that gets completed at the end of the audit. When the financial audit is done, the audit team can turn to the performance statement, which is not really the best time to be doing it. It really should be done in line. So that's where auditors can tend to improve. Having said that, it's always great if often some clarification can be required during the review of the performance statement, and a shelf performance statement using the current year model is a great way of addressing those queries. Next bullet point, again, it's probably something obvious to some councils, maybe not so obvious to others. Just making sure that the trial balance is finalised and fully reconciled. One of the most difficult challenges from again, logistics or a time perspective is working with a moving target. Having to pick up and drop down, then pick up again a particular area because of adjustments or changes to the balances. Or where when reviewing the reconciliations, we can see that there's significant variances. We do appreciate that sometimes time can be short and that sometimes resources can be stretched. And so having a trial balance that's not finalised doesn't need to be the end of the world, but again, it's just about communication. So it's just letting us know, or letting your auditor know what hasn't been finalised, and then it's working out between your auditors and yourselves of what areas should be left towards to a later stage of the audit and what can be done up front. And also determination can be around the significance of those balances. So clearly, if it's a significant balance like infrastructure assets, and that's going to cause more of a challenge than if it's something like prepayments, which is in most cases going to be immaterial from our perspective. The other one, again, is just most auditors will provide a requirements list or request for information or a audit requirements listing. Again, it's really, it helps the efficiency of the audit and the time of the audit if that's completely completed or all those requirements have been fulfilled. Again, we appreciate that time can be stretched and there can be issues. So it's just a matter of letting us know if information can't be provided within a time, so we can work out, or auditors can work out when to time their audits. And I guess the other thing is also sometimes we might be asking for something and we may not be using the right language or terminology, or we might not be absolutely clear on what we're after. So again, you should be feeling free to contact your auditors to clarify a particular item just so that information can be available. And maybe it might be that the information may seem excessive. So again, it's an opportunity to kind of get the auditors to justify why they're asking for something and to clarify why they need what they're asking for and how it fits in with the audit. And then I guess finally is in terms of logistics is the availability of staff. Again, we appreciate that people have other commitments whilst we're doing the audit. People's day-to-day duties don't just disappear, they still need to be done. And we also understand sometimes people have leave they can't avoid, whether it's sick leave or some other form of personal leave. So generally what works best is that if you communicate the availability of staff. So when when auditors are looking at what balances to focus on, they can base it around who's available and when. Clearly, there's a lot more flexibility when we're doing our interim audits to when we're doing our final visits, but this obviously we can still work around when we need to. I'm feeling a bit sheepish about raising this one, just given that Carmen has already said that, has already mentioned that this is one that's probably been done to death. And I know with the councils that I work with that I've discussed the valuation process with audit committees and with finance teams. And you would have also seen that the standard interim management letter points that have been released by Vargo and that have been included in the interim management letters this May have also raised matters around fair value. So I'll because we're running out of time, I'll be very brief. I suppose some of the key things, and so I'm not overlapping with what Carmen said earlier, is we do sometimes find that when we look at the accounting policies of councils in terms of when a full comprehensive valuation needs to be done, it's sometimes not done within the timeframes stated in the council's accounting policy. So we just ask that you look at that and consider that when, and acknowledging that June is leaving it pretty late, but again, just being aware of that issue where whether a full valuation is due or not. The second one is really is doubling up with what Carmen said before, but it's looking at the valuations and making sure that the finance team has actually looked at those valuations and assessed those valuations, particularly in terms of inconsistencies with prior ones. Infrastructure is always, in particular, is always challenging, particularly as Carmen said, there's a new valuer where sometimes the numbers by one is completely different to the prior one, and it can't be explained by inflationary pressures or any other factors. It just seems to be completely different. And sometimes, so it's just making sure we have a thorough understanding of why they're different, what the root cause of those differences are, and what the implications are in terms of financial reporting and how they're processed. The other thing is always making sure that the valuation does also consider a condition assessment. So it's not just looking at the numbers and the values of a particular item, but it's also considering the condition of those specific assets. And another matter that, again, that I've discussed a number of times with audit committees this year, just in line with Vargo's parliamentary report, and in terms of making sure that the audit committees are aware of the valuation process, some of the implications or the results of the valuations, and also making sure that they're comfortable with the valuation process. And finally, on valuations, which luckily isn't doubling up, but it's perfectly fine to provide auditors with draft valuations. We don't need to wait for the final version, because really what we want to see is we want to see what the methodology is. We want to see what the numbers are, how the numbers were derived, and 9 times out of 10, there's not going to be a dramatic change between the final and the draft. We'd appreciate if you've got your own queries for the valuers, we appreciate having them to give some context to the draft, but the drafts are very useful for us because it allows us to look at it sooner rather than later, in case there's issues later on. Just mindful of time, I apologise if I'm rushing through. The other one is, again, what Carmen said, is just making sure that those fair value assessments are done outside of those full comprehensive valuation years. And I guess one of the issues is probably the two key things is what the action is taken once the fair assessment is done. So once you've got a number, basically making that decision of is an adjustment required, when is an adjustment required? So just referring to materiality thresholds, and also working out whether, based on the scale or the significance of the adjustment, whether a full valuation is actually needed, rather than relying on just a fair value assessment. And I've just put a note down below, just in terms of the financial report disclosures, just to make sure that the details of the valuations are updated in the financial report, and also making sure that those notes, so the different notes, the statement of cash flows and the statement of capital works all flow and make sense with one another. We appreciate that the statement of cash flows is not always going to equal, it's cash versus accrual accounting, but it's just making sure that there's some kind of that there's a rationale for differences. Just other areas, again, I'm just mindful of time and allowing for questions. Grant revenue, again, this is another area where I'm doubling up a bit with Carmen, but is just making sure that there is some kind of documentation or process done to review any new grants, particularly grants that are received late in the financial year. in terms of making that assessment between AASB 15 and 1058, and also making sure with those applying to 1058 that there is a distinction made for operating versus capital grants, making sure that they're recognised correctly through the trial balance and ultimately to the financial statements. And again, just the relating notes. Some notes actually tie to each other. So the revenue note will have unspent funds. Some that will be for operating grants, others will be for deferred for capital grants, and making sure that the movements in those capital grants is reflected in later notes. Non-cash developer contributions. I guess there was an issue that sometimes there can be an issue in terms around of completion or cutoff of non-cash developer contributions. So one of the key things I know Travis Derricott at Vargo is quite big on is making sure that that the finance team is talking to the asset management or planning teams within councils to make sure that those non-cash developer contributions are hitting the general ledger and are ending up on the fixed asset register. And then finally, just a provision of landfill rehabilitation is, again, just making sure the models are updated for the current year. Adjustments are made for any costs that may have changed, and that there's evidence to support those costs and their timing. And finally, just performance statement. So again, I know in my early days, and I've considered this a flaw, so I'm happy to admit my errors, that you get so caught up in the financial statement that once you're done, you then realise you've got the performance statement. So we're quite mindful now that we need to make sure that they're being done that the performance statement is looked whilst the financial statements. And so we're making sure now that there's that there's a lot more that the process is a lot more orderly going through the performance statement. I suppose to help us through that process is that it's important that there's just one person responsible for the performance statements. We have come into occasions where multiple people, because the information comes from multiple areas, multiple people are involved in the preparation of the performance statement, and it can be challenging to make sure that the audit is completed whilst trying to make sure we have enough coverage in terms of our audit testing. So it is good to have that one contact, similar to generally with the financial statements, we have just one person that we need to, that we work with. Making sure there's a lot of financial data that's in the performance statement. So it's making sure that someone who is knowledgeable of the data required, and the sourcing of that data, and also the calculations is involved in checking and reviewing those indicators. And similarly with the non-financial, it's just making sure that those responsible for preparing the performance statement are aware of the systems and processes in place in terms of the completeness, accuracy of the data collected for those non-financial data. We also ask, it can help if the information supporting the disclosures in the performance statement are compiled in a single file or a single, in a single place, so that it can be easily verified as we work through the performance statement. And finally, just in terms of the comments column or the explanations in the performance statement, is we often find that the comments are either not updated or sometimes just referring to the prior year. But from a reader's perspective, that can be a bit confusing because they're looking at multiple years rather than just the 1 year. And for some indicators, they may be looking at budget figures or forecast figures. So it's just looking at making sure that based on the numbers available and what the reader can see, is that the comments actually reflect those figures. So yes, I probably rushed that last bit a bit, but I'm happy to take questions.
Thanks, Nick and Carmen. We've got a couple of questions in the chat. We have a question from Alan. AASB 22-10 greenfields versus brownfields versus current replacement value and LGV guidelines on fair value. Any thoughts?
It's probably a very big question for the webinar. It is an area that I know people struggle with. And I saw the question and I was trying to remember, is there extra guidance in 22-10? I think there is. I don't necessarily think it's going to solve all of your problems and give you absolute answers. At this stage, I probably don't have anything to add because I think it's probably a bigger question than this. Nick, I'm not sure if you've got anything on that one.
No, yeah.
Okay, and we have another question from Simone. If the sustainability, sorry, get another message popped up. Away. If the sustainability climate-related disclosures are legislated in January 2025, which financial year would they apply to? 25-26 or 24-25?
So remember, first of all, this is just for companies. So I will just remind you of that. This is not me telling you this is going to be in place for councils. The plan is that they need to be legislated before November 24. And the intention is that for the companies, the largest companies, the Group 1 companies that are being captured, and I can never remember the thresholds, but it's $1 billion worth of assets, I think 500 million of revenue, 500 employees, I think. They will have to apply this for financial years beginning on or after 1 January 2025. So that is 31 December 25 will go first, 30 June 26 will follow them. But please don't take the message that I'm telling you this is in place for councils on that date. It is absolutely not. It is just what the federal government is proposing for companies.
Okay, I don't think we have any other questions at the moment. So I'd just like to thank you both very much for your time today. Very interesting presentation and very timely in preparing for year end. So thank you both for the chat today.
Thank you.
Thank you.